Hello there, welcome to the Vital Investing channel. Today is Monday, January 24th. Hope you've had a nice weekend. Last week was another deep red week, with many tech stocks continuing to be bashed. There's many, like myself, who have been holding tech shares since months ago must be feeling lost and perhaps develop a phobia of even looking at our trading account. But I think I've got a solution to get out of the doom and gloom situation above. That is, to have a much longer term investment horizon. That's right. Stretch your investment horizon longer, like 5 to 10 years, and you might just realize the crash now may just be the window of opportunities to get fundamentally good stocks which are at huge discounts compared to just months ago. The key question is now the right time? The quick answer, I believe, is no, at least not yet. Not when the S&P 500 and Nasdaq have nosedived for 4 consecutive days, hitting their new lows since March and July consecutively. This is the worst first 2 weeks for the new year since 2008. Even the mighty FANG stocks are not spared, with Netflix brutally slashed more than 20% in a single day. The market is sent into panic mode, with many shouting to sell out the S&P to escape market massacre. Wait a minute. I couldn't help but to recall this Pareto principle, where 90% of people invested in the market will be losing money and only 10% will be reaping in the profits. I suspect it's this same 90% of people that are shouting to sell their shares right now as they are unable to take the pain of their shrinking trading account balance. It's funny, isn't it? When one sees red in the portfolio and the only thing one's thinking is to sell the losing stocks to reduce the pain. Shouldn't this be the time to accumulate good stocks when they are at a steep discount? To be frank, the majority of my holdings have turned red as of now. Heartache to see, yes. But truth be told, I've only entered the first or second tranches for most of them. Imagine the market rising sky high just right after I bought my initial tranches. I would not have bought enough in the first place. But buying more during periods like this is like trying to catch a falling knife. Then we have Peter Lynch, who famously said that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. So what I've done is that I re-looked at my long watch list. Many of them started to display strong technical buy signals, but only a handful of them are screaming buy right at my face. These are the ones that I thought the boats had set sail without me, and I thought there was no chance for them to U-turn for me. Lo and behold, many of the ships have U-turned back for us. Thanks, Mr. Market. Or should I say no thanks? Anyhow, the boats I'm referring to are those I've ultra high conviction in. They are Apple, Adobe, AMD, Amazon, Salesforce, Disney, Facebook or now Meta, Google, MasterCard, Microsoft, Nvidia, UiPath, PayPal, Sea Limited, Square or now Block, Shopify, TSM, The Trade Desk, Unity, Upstart and Visa. The important thing to take note is that there is a floodgate of upcoming earnings calls, with giants like Microsoft, General Electric and Johnson & Johnson releasing their earnings on Tuesday, Tesla and Intel on Wednesday, MasterCard and Apple on Thursday, and so on. All eyes are on Microsoft and Apple, which are critical in setting the tone for market mood for the short term. But with the economy trying to resume post-COVID and expected drop in demand for computers and smartphones, these are not really good news for Microsoft and Apple. Anyway, who knows? Let's hope Microsoft and Apple are able to inject some positive vibes to the current volatile market. Nevertheless, with the impending Fed meeting on Tuesday to Wednesday, the entire market is zooming in on the tone set by Jerome Powell on how hawkish he will be and the actual implementation of interest hikes. Back to my high conviction stocks in my watch list. I'm currently eyeing Amazon, Google and Microsoft. Now that these golden boats have made a new turn for us, let's see if this is the chance for us to get on board. Now, I'll skip going through the fundamentals for Amazon, Google and Microsoft. They are indisputably fundamentally excellent companies. Let's jump straight into their charts. Amazon, its last closing price of $2,852 is way below the 200 moving average in bold white. For many times, this 200 EMA line formed a strong support level. Every time the share price dropped below this 200 EMA, it rebounded. This time round, it nosedived with the money flow index MFI turning green below 25%, which is in the oversold region, even for my favorite BI app. Amazon is currently undervalued. I repeat, undervalued. With an intrinsic value of $3,332, that's a 14.38% upside or margin of safety. And is Amazon amazing? The only caveat here is that the AMZN is a rather high ticket at 8K per share currently, so it'll be hard for small retail investors to dollar cost average. For myself, I'd be willing to grab Amazon under $3,000. Hope my GTC for it can be filled this week. Next we have Google. Yes, my long-time favorite. Finally, I repeat finally, it came down below the 200 moving average line. Same thing here. Its money flow index MFI is in the green oversold region. Just that from BI app, Google is still above its intrinsic fair value. That being said, Hey, it's Google. I'll be glad if I can pick it up with a GTC of $2,500. Then with Microsoft, same storyline here. 200 EMA line breached. Green MFI oversold signal. DI app-wise, due to a strong climb in 2020 and 2021 during the pandemic. Even with recent sharp retracement, it's still a distance from its fair valuation. But again, hey, we're talking about Microsoft. I repeat, Microsoft. Anything below $300 could be a good buy right now. But hey, Microsoft is going to release its earnings this week. If and only if it misses any of the numbers, there might be a good drop to scoop up Microsoft at better GTCs. Fingers crossed. One important disclaimer though, I'm by no means a financial guy and all the above are not recommendations to sell or buy. I've been wrong with my analysis before and I'll be wrong moving forward. But what I believe that I'm right is, as long as we invest in good companies with a long-term horizon, our chance of investment success should be pretty high. Till next episode, see you in the land of abundance.